Welcome to this explainer. Today, we're embarking on a seriously fascinating comparative journey. We're going to look at the rigid, highly structured mechanics of the traditional stock market and compare them directly to the 24/7, high-octane world of cryptocurrency trading. You know, if you've ever felt completely constrained by traditional trading hours, or maybe limited by your starting capital, the source material we're breaking down today offers a very different perspective. Okay, let's dive right in.
Here's our roadmap for today. We'll start with stocks versus crypto trading, move into the 30% tax problem, look at spot versus futures, tackle leverage risks, break down maker versus taker fees, and finish up with the best trading hours.
All right, Section 1, Stocks versus Crypto Trading. Let's look at how these markets actually stack up against each other. To really understand why digital assets are drawing so much attention, we have to look at the fundamental friction points of traditional markets. Just look at the sheer contrast in accessibility here. According to the source, traditional stock markets in India operate strictly from 9:15 a.m. to 3:30 p.m. For most people, whether you're working a 9-to-5 job or you're stuck in college classes, those hours are incredibly restrictive. You're busy exactly when the market is open. In contrast, the crypto market operates 24 hours a day, 7 days a week. Plus, traditional intraday stock trading typically captures leverage at about 5 times your capital. Crypto? It offers up to a staggering 200x leverage, so you can trade whenever you want with massive potential amplification. But seeing this massive difference in flexibility and leverage brings up an obvious question, right? If the crypto market offers all this, why isn't absolutely every stock trader making the switch? Well, the answer lies in the rather harsh realities of local regulations. That brings us to Section 2, the 30% tax problem. Let's talk about crypto taxation in India. Let this number really sink in for a second. 30%. The Indian government classifies cryptocurrency as a digital asset, not as legal tender. And while trading it isn't strictly illegal, the government has slammed a massive 30% flat tax on spot crypto trading profits under Section 115 BBH of the Income Tax Act. So, why is that 30% so punishing? Well, it's not just the flat tax on your profits. The real kicker here is that you literally cannot set off your losses against your profits. Let me explain. If you make a 10,000 rupee profit on one trade, you owe 3,000 rupees in tax. But if you lose 10,000 rupees on the very next trade, you still owe that original 3,000 rupee tax on the first trade. Plus, there's a 1% TDS on transactions exceeding 50,000 rupees a year. The source notes that this inability to offset losses is exactly what drove a huge wave of traditional traders completely away from spot crypto buying. Which leads us to Section 3, spot versus futures trading, and how some traders are navigating this tax. So how in the world do traders actually navigate this? The crucial point the source makes here is that you don't actually have to trade spot crypto at all, meaning you don't have to directly buy and sell the actual coins. According to the source, trading crypto derivatives, specifically futures, legally bypasses that harsh 30% spot tax rule. Why? Because you're trading a derivative contract based on the asset's price rather than transacting the underlying digital asset itself. Now, we're simply explaining the source material here. We're definitely not giving financial or tax advice, but structurally, it's a fascinating workaround.
Now, if you're coming over from the traditional stock market, your brain probably jumps straight to options trading. But there is a massive distinction here. Crypto options have fixed expiries, and they suffer from theta decay, which means they actively lose value over time even if the price of the coin doesn't move at all. Crypto futures, however, are what the source highly recommends. They utilize what are called perpetual contracts. This means there's absolutely no expiry date. You want to hold a trade for an hour, a week, or a whole year? You can. There is no theta decay, and you get access to that massive 200x leverage.
All right, Section 4, Leverage and Liquidation Risks. Let's get into the mechanics of how this works. To see how this actually works in practice, let's walk through how a trade builds. Step 1, you put in just 1,000 rupees of your own capital. Step 2, you apply the exchange's 200x leverage. Step 3, you are now suddenly controlling a market position worth 200,000 rupees. Step 4 is where the magic and the extreme danger happens. If the market moves up just 5%, your profit isn't 5% of your 1,000 rupees, it's 5% of 200,000 rupees. That is a 10,000 rupee profit on a mere 1,000 rupee investment. It's incredible. But remember, leverage is a double-edged sword.
And that perfectly leads us to a very scary word in trading: liquidation. Think about it. If that 200,000 rupee position drops by just 0.5%, your loss is 1,000 rupees. Since 1,000 rupees was all the personal capital you actually put in, the broker is definitely not going to risk their own money. They will automatically exit your trade and your initial investment is entirely wiped out. Gone. That is liquidation. Basically, the higher your leverage, the closer your liquidation price is to your entry price.
Because of this intense risk, the source offers some super practical advice for beginners. While you can technically test the waters with as little as 100 rupees, the recommended capital to actually practice proper risk management is between 15,000 and 20,000 rupees. And what about that crazy 200x leverage? Yeah, the source advises avoiding that entirely as a beginner. A safe leverage to utilize is a maximum of 20x to 25x. This actually gives you room to breathe in the market without facing immediate liquidation from some tiny random market fluctuation.
Moving on to Section 5, Maker versus Taker Fees. This is vital for understanding your order costs.
If you're going to trade differently than you do with stocks, you need to understand exactly how crypto orders are executed. First, just like traditional stock options, you don't just buy random fractions of a contract. Crypto futures trade in very specific lot sizes. For Bitcoin, one lot is 0.0001 BTC. For Ethereum, it's 0.01 ETH, and for Solana, it's 1 SOL. Understanding these specific lots is absolutely crucial for accurately calculating your position size and keeping your risk in check.
Once you know your lot size, the way you actually enter the market dictates the fees you pay. A maker places limit orders. By setting a specific price and waiting for the market to come to you, you're essentially adding liquidity to the exchange's order book. Exchanges love this, so they charge you significantly lower fees. On the flip side, a taker places market orders, buying or selling instantly at whatever the current price is. This takes liquidity away from the market, so takers get penalized with higher fees. The source makes a great point here. Simply switching your habits to use limit orders can easily cut your brokerage fees by more than half.
And finally, Section 6, the best trading hours. Let's talk about timing your trades. We know the crypto market is open 24/7, but when is the absolute best time to actually apply all these concepts? Let's anchor this right back to our very first comparison with the stock market. The Indian stock market closes at 3:30 p.m. Now, over in crypto, the London session opens around 12:30 p.m. local time, which brings in some really good liquidity. But the real magic? That happens at 7 p.m. when the US session opens, bringing massive volume and volatility. Notice how perfectly this aligns with the time traditional stock traders finish their day jobs and settle in at home. You aren't forced to squeeze in trades during your work hours. The most lucrative time in crypto happens right in the evening.
And when you are logged on trading during those peak hours, the source has one final, absolutely crucial strategic tip. Stick strictly to the major legacy coins. We're talking Bitcoin, Ethereum, and Solana. Because these coins have massive global volume and high liquidity, it ensures you can enter and exit your trades effortlessly. But more importantly, it drastically lowers your risk of getting caught in the sudden catastrophic market manipulation that you constantly see wiping out traders in brand new, low-cap meme coins.
Finally, to tie the regulatory side together, the source notes the importance of where you actually choose to trade. Utilizing a platform that is registered with the Financial Intelligence Unit, or FIU, like Delta Exchange, which the source specifically points out, ensures basic local regulatory compliance. It also just solves the massive logistical headache of funding your account, allowing for totally seamless deposits and withdrawals directly in Indian rupees.
Which brings us to the end of our comparative journey today. We've seen exactly how the crypto futures market offers unmatched 24/7 flexibility, massive leverage, and some really clever structural ways to navigate heavy spot taxes. But we've also stared down the terrifying reality of auto-liquidation. So, knowing the immense power of perpetual contracts, are you ready to jump in and navigate the fast-paced world of crypto futures? Or, after seeing all that risk, does the structured, predictable safety of the traditional 9-to-5 stock market suddenly look a whole lot more appealing? Think on that. Thanks for joining me on this explainer, and keep learning.